So what are government securities? Government security are mainly of three products, which is Treasury bonds, Treasury bills, and repurchase agreement, which we also call it repo. A government security is a debt instrument issued by the government of Sri Lanka with a promise to repay at the maturity. Government security investments in Treasury bills, bonds, and repo are considered as default risk-free due to the government backing. As you can see, Treasury bonds have periodic interest, which we also call coupon payment, which is paid in every 6 months, and a face value repayment at maturity. Bonds can be issued at a discount, at a par, or at a premium, and also issued for a longer term. Let me explain you about this. Bonds can be issued at a discount. It means bonds which we issue are lesser than the face value. At par, it means bonds which we issue is at face value. Or at a premium, it means the bonds which we issue are higher than the face value. Treasury bills. Treasury bills are issued at a discount and repaid at face value. Issued for a short term, example 1 year. And also central bank's public debt department issues and ensure timely repayment. Moving on to the biggest question, what are Treasury bills and bonds? Treasury bill is a short-term investment starting from 3 months, 6 months, and 1 year. This is issued at a discount. No coupon payments are issued in a bill. Face value paid at a maturity. And also, if we talk about bonds, bonds are starting from mid-term, it goes to long term. Starting from 2 years, it can go up to 30 years. There, we pay a semi-annual coupon at a fixed rate. And also, a return is referred to as a yield to maturity. Let me explain the benefit of short-term investment and long-term investment. Short-term investment. Short-term investments are often more liquid, which means you can quickly convert them into cash without any significant loss of the value. This makes them suitable for immediate cash need. Short-term investment plans provide more flexibility, allowing investors to adapt to changing financial circumstances or investment opportunities. When comparing short-term investment with long-term investment have a potential for high returns compared. This helps investors build wealth over an extended period. So let's move to the most active instrument at the moment. What is a repo? A repo is a short-term investment like a deposit, but secured with a treasury bill or a bond. It matures from day 1 to many months. This also can be used as a lucrative alternative for fixed deposits. In case borrower fails to uphold the agreement, the investor can liquidate the collateral given by the borrower, and also this is a fixed rate and a return investment. What is a haircut? A haircut is the excess value of security provided by the borrower to the lender. This margin is determined by the central bank. And also, the MRA agreement will be an important mandatory document when you invest in repo. Master repurchase, we call it master repurchase agreement. Let's move on to the next slide. The purpose of primary dealers. The intermediary between the government and investors are the primary dealers. Primary dealers like First Capital are appointed by the central bank to intermediate between the government and the public to circulate the government securities. Primary dealers are also bonds and trade bonds and create a secondary market liquidity for price discovery. Now let me hand over the presentation to Mr. Sachith Perera, the Chief Executive Officer of First Capital Treasuries. Here, over to you.
Okay, so to go through how the government securities market works, this all starts from the government's borrowing program that flows from their fiscal operations or the annual budget. So the government has to fulfill two requirements each year in terms of their borrowing program. One is to finance their existing maturities, so they need to roll over that. And the second is financing of the fiscal deficit. So once that is done, so basically they have to also come up with a mix in terms of how they will finance the fiscal, the entire borrowing program, how they are going to finance it. So they have multiple options. They have access to foreign financing. Currently, we assume that it is not available to the government because of the current situation that we are in and the fact that we are in sort of selective default. But we still have multilateral and bilateral funding that comes as fiscal support that basically reduces the amount in which the government has to depend on domestic securities to finance their funding needs. This requirement, once assessed, will then go through a cash flow assessment by, I suppose it's probably between a joint effort between the government of Sri Lanka and the Treasury in terms of the government's revenues and the payments. Then central bank has to also now take into account the gross financing needs. They are not supposed to exceed a certain threshold in terms of annual rollover of government debt. Those things also will go into their computations, the funding mix, duration. Those things will be decided by the issuer, and then based on that, the central bank will come up with a bond or a securities issuance program. Now, the securities issuance program is not necessarily announced to the market in advance. We have the ability to make a fair projection in terms of the government's borrowing program based on the maturities. But in terms of how they are going to finance the fiscal deficit is something that we can only estimate. But sufficient notice is given whenever they come up with a primary auction. Usually, the bill program is known in advance. The bond program can be a little ad hoc, but as I said, can be sort of projected with a fair degree of accuracy. So then, so this is what's on the screen, shows a flow chart of the issuance process. So the ultimate borrower is the government of Sri Lanka. The agent to manage that borrowing program is the central bank through their public debt department. The method in which that they source the financing is the primary auction. On rare occasions, the central bank or the government can tap into short-term funding from state-owned entities or even other commercial banks as and when required. But it's mostly, I think, 99% of the funding requirement would come through the primary auctions. So at the primary auctions, primary dealers are the only entities with access to the primary auctions. All other entities have to channel their primary auction requirements or their bids through primary dealers. And then finally, the primary dealers will distribute to the investors, not only those who come directly to the auction, also in the secondary market to those who seek to buy these auctions, buy these securities after the auction. So this is a basic pie chart of the current holders. Actually, this is at the end of last year. So the current numbers have not been published yet. So if you, but I think it probably will not make a significant difference from where it is now. The biggest chunk is currently held by commercial banks. There are economic reasons for that. The superannuation funds like EPF hold the next largest chunk, around 27%. This is at the end of 2022, and the central bank currently has something close to 20% due to the large stock of securities that they had to buy in 2021, 2022 to finance the government due to a large fiscal deficit. So this component of the central bank's holdings have been now converted into long-term bonds in the DDO process. The EPF and the other superannuation funds also had a certain level of re-optimization of their holdings. The rest of the market, like if you look at specialized banks, finance companies, insurance companies are relatively small, and these are the three large holders of the government's bond program, bond issuance. Okay, so talking about the secondary market. So a secondary market is required to create a deep and vibrant market where it's easy for buyers and sellers to actually enter the market and exit with ease. A deep secondary market can actually have very narrow prices. On the other hand, a shallow secondary market where there is very limited number of transactions that take place, the secondary market prices can be quite wide, as well as the positions that people take, the investors take, can be sticky. So let me also conclude by giving some trading strategies that we follow. Different investors will have different preferences for what type of investment strategy to adopt. For instance, if you look at an investor who would just like to buy a bond and then just earn a yield and hold it to maturity, that kind of investment is called a passive investment. Basically, it's not an actively traded position. Some banks, insurance companies can use to hedge their interest rate risk coming from their liability books. That also is a passive investment, a hedging position. And then individuals, companies with long-term funds can use this investment strategy to lock in returns for long term. Now, for instance, currently the interest rates are around 14% for 5 to 10 years. This is a good time to lock in if you assume that interest rates would go further down. So for people who want to lock in, passive investment is a good strategy. But for traders in the market, like primary dealers, there are trading desks in commercial banks and other traders, they would like to, take a short-term like a 90-day, 180-day trading view in terms of market movement. Then you quote two-way quotes for trading gains, that is sell to as a market maker, sell to the investors, buy from others who want to sell, buy in the primary auction. So that gives us a trading profit. Then you take a directional view. So for instance, you can buy at 14% as it stands now, and then hope sell it at 30%. That will basically give you a capital gain. Then there's also a strategy that, for somebody who is watching the market very closely, you can see some areas of the bond yield curve that is mispriced. We call them arbitrage opportunities. We can take those arbitrage opportunities to make a trading gain there. Then another type of trade done by traders again, mostly, but companies as well as other types of investors also take opportunities in this this kind of trade. So basically, the strategy is to buy high-yielding bonds and then financing it with low-yielding short-term funds. So if the interest rates for short-term is 10%, long-term 5-year bond is say 14%, there you can generally have a 4% interest gain on a daily basis. But this is a risky strategy due to the leverage, high leverage there. If short-term interest rates go up, like it did in 2022 quite sharply, this could actually lead to a significant loss to a trader taking this kind of position. Then the fourth type of trading, algorithm trading, basically it's based on an algorithm written by a trader on macroeconomic or technical charts for you to inform of trading positions. And sometimes, other countries, in more advanced markets, I know banks sometimes use bots to execute these transactions. But in a country like Sri Lanka, I think the algorithm trading can still be done, but with manual execution of transactions. That's it. And thanks. And let me hand over back to Shehani.
Thank you, Mr. Sachith Perera. So now I will give you a few minutes. This is the Q&A session. You can come up with the questions if you all have any questions. Thank you.
Essentially, the funds lent to a primary dealer, say First Capital, is technically a loan extended to the government through the product of repo. For a repo, well, that is given to a primary dealer, the primary dealer in return gives a treasury bond as a security, which is something that they had previously bought. So the funds that basically come as a repo will make the primary dealer purchase another bond or will reduce another repo. Primary dealers are allowed only to buy government securities as assets. 99% of their asset book is in government securities. So essentially, any repo means it is lent indirectly to the government, as opposed to buying treasury bills or treasury bonds directly.
So the next question, will banks lose interest in government securities after the completion of debt restructuring?
As long as the government keeps issuing debt, and there is a large number of investors already in this government debt, the market will continue to operate. The banks currently have close to 40% in commercial banks, if that is the question. Commercial banks have about 40%. If the question is whether that will go down because banks lose interest, that could be the case if the government, the banks, private sector credit uh, lending grows from where it is now. So one of the reasons why the commercial bank lending is so high compared to the others is because of the slow loan growth into the private sector. So I don't see a reduction in interest. It actually is required for various balance sheet management purposes.
Next question is, how can someone start to invest in treasury bills for the first time? So the new clients who would like to invest with First Capital Treasuries, they can open an account online through our website, and also they can visit us to our office. We are in Deal Place, Kollupitia. There are 3 agreement documents which you need to sign and fill up: the account opening document, CAD agreement, and the MRA agreement, which is mandatory to open an account to reinvest with repo investment. So you can, after you fill up all these forms and hand over, you will get a instruction email via via First Capital, and you can give us instructions what you need to purchase, and through email that also you have to give. Then you can invest with First Capital. Thank you. So there is another question to you, Mr. Sachith, that you mentioned several investment strategies here. Can First Capital facilitate these to investors?
Can give a generic answer to that. Yes, that is what we do. We actually cater to all these 3 types of investors, but except for the final one that we had mentioned there, the algorithm trading. We're actually working on a model to develop a algorithm locally to be executed manually, because we don't want bots to be traded, nor do we think we'll get regulatory approval for that. But the other 3 things, the active trading, passive trading, and also the carry trade, is something that we do on a day-to-day basis. We have multiple clients who will adopt one strategy or the other. We are, as a primary dealer, we are naturally an active trader. We also have passive investments from time to time. We also sometimes take carry trades. So we basically do a mix depending on our view on interest rates and the shape of the yield curve. It basically will make that decision from time to time. But we facilitate all kinds of investors.
There's another question to you, Mr. Sachith. Recently, central bank buyback of bonds. Please explain rationally and whether they did so at a capital loss or not.
Well, whether it's done at a capital loss, it's difficult to say. It depends on when this was issued. If they were issued when the yields were low, say at 8 or 9%, and then they are forced to buy back at 13, 14%. Sorry, if they were issued at a higher yield and then buying back at these levels, they would have a capital loss. But I assume that these bonds may have been issued at a lower yield, like 12%, and then if they get an opportunity to buy it back at 13, between close to 14%, that will probably make a capital gain for them. As the issuer, you have to look at it from the issuer's point of view.
Okay, the next question: what do you expect in the future on interest rates as VAT comes into play?
So generally, any tax increase is positive for interest rates, because that basically will contain the fiscal deficit. And the fiscal deficit is the worst thing that can happen to in terms of interest rates. So if VAT increases and the government's revenue goes up, and thereby reducing the fiscal deficit, especially in the coming year 2024, 2025, where access to external markets are limited, I would expect interest rates to actually head lower from here.
So the next question, could you provide insights into any recent or upcoming changes in the regulatory framework for the Treasury security market?
There hasn't been any regulatory changes specifically impacting the market, apart from the recent central bank act that gives the central bank more independence. Now, with that independence, it is possible that the central bank will manage the market with more predictability from a market participant's point of view. So if that is a regulation that we are talking about currently, it is positive for the market because we think the central bank will be at a better position to manage the interest rates and inflation than they could previously.
So the next question, how is repo different from a fixed deposit? What are the advantages?
So, okay, in terms of how the repo looks in the hands of a customer from the way he does the investment, there is no difference because there is money given, and at the end of a period, you get your capital plus the interest. The advantage is that in a repo, as opposed to a deposit, you get a government security as collateral. So even if the primary dealer or the company that you lend the money to or a bank that goes down, you still have the security to fall back on. So the security is also transferred to an account that is in your name into a depository called Lanka Secure, which is managed by the central bank. So you get security on the strength of the company's balance sheet. If you look at a primary dealer, primary dealers have 99% government securities, so very little credit risk. Yes, they have market risk, but sufficiently capitalized for in line with the risk that they take. So repo, I would say, is a safer instrument than a deposit.
And the next question will be, how will the budget of 2023 impact short-term investment plans such as money market funds?
So we have already seen the market react to rather what can I say, a satisfactory budget. I mean, we can't just be completely satisfied, but a positive budget, we can say, from money market point of view. So we expect interest rates to come down. Short-term interest rates, we think will come down close to 12%, even lower, in which case the money market funds also will head in that direction. There's a lag effect because of the previous investments that the money market funds have made. Those are still in their portfolios. As they start maturing, their investment is going to be at a lower rate, so the money market yields actually will trend down. But already it's at a higher rate because of the older positions that they had taken. It's already higher than the short-term interest rates currently.
So thank you everyone for participating to the webinar. Hope you all had a good time and you all got information about government securities. Thank you so much.